on your paycheck, you'll have your gross pay and your net pay. And the gross pay is what you actually earned, your hourly times the number of hours you worked or your salary, before any deductions have been taken out. And then your net pay is what you actually receive. That's the pay that you get to take home after they've taken out income tax, Social Security, Medicare. At the very least, you'll have those three things taken out. And then if you have insurance, retirement plan, any other kind of deductibles, flexible spending account for health care, some people have wages taken out to pay for child care. You know, there's a lot of different things that they can take out for, and that just depends on, one, what your employer offers, and then two, which of those offerings you choose to accept. You know, for example, your employer could offer a 401k plan, but you could choose not to participate in it. You know, it's up to you. Yeah. It'll be low if you, it's a percent, right? So the amount gets taken out depends on, I mean, for taxes anyway, and Social Security, the amount that gets taken out depends on the amount you earned. So the more you earned, the bigger the chunk they take. You, oh yeah, they have to. Also, you have on your taxes, the amount they take out is based on what you make. The percent is also based on what you make. There's different tax brackets based on the earnings that gives you the percent. So people in a lower income pay a lower percent. People in a higher income pay a higher percent. Your paycheck stub. Now, you may or may not actually receive a paper paycheck stub. Some companies do them only electronically now to save paper, but you should, legally, you are allowed to have access to it. So they have to either give you a paper paycheck stub, or they have to provide a place where you can get the electronic paycheck stub. And it lists all of your salary or your hours and your wages. It lists every penny that they took out of your check and what it was for. They have to list all of that on your paycheck stub. Then when you first get your job, so when you're very first hired, oops, why did I do that? You fill out a W-4. That's this one right here. And this is the one where you claim your exemptions. And there's a worksheet, as we have discussed. Has anybody not seen a W-4 before? Everybody filled one out before? Okay. So when you first get there, and there's a worksheet, and you can figure out how many you're allowed to claim. Again, this is where I tell you, if you're single, you should just claim 0, so that you don't end up owing taxes at the end of the month, or at the end of the year. But this is W-4. The actual name of the form is the Employee Withholding Allowance Certificate, and then the form number, code number is W-4, but everybody just calls it W-4 because nobody wants to say Employee Withholding Allowance Certificate. This number, that after you fill this out, you put your Social Security number on there, all your information, your address and everything, and the number of allowances that you claim determines the taxes that they're going to take out of your check. The higher the number you put on there, the less taxes they will take out. However, it doesn't matter what you put on this form. At the end of the year, your tax bill is going to be your tax bill. So having less taxes taken out of your paycheck doesn't mean you'll owe less taxes later. Does that make sense? Because on your W-4, you can actually put any number you want within reason. I mean, you can't put like 100 probably, but even if you're single and you have no dependents, you could put 5 on there if you want to. They're going to take out a lot less taxes out of your paycheck, but at the end of the year, you're going to owe a bunch of money. So this form determines how much they're taking out of your check, but it doesn't actually determine how much tax you owe. So just be careful with that. Withholding taxes, those are the federal, the state, and local. We don't have state and local taxes here. But the majority of states have a state income tax. In addition to the federal income tax, I think it's actually like 46 to 48 states that have state income tax. And then some areas also have county income tax. That would be the local. So if you're considering relocating, but you don't want to pay a whole bunch more in income tax, you might want to check that kind of stuff out before you go. But Florida has no state income tax or local income tax. But because the forms are universal federally, they'll all have stuff on there about state or local tax. Even if it doesn't really apply to you, you just ignore it. Your W-2 is what you get and you need to file your taxes. There's two major forms, the W-2 and the 1099. There's also 1098s and other things. The W-2 is actual wages that you earned as an employee. So my hourly or my salary. The 1099 is what is considered non-employment income. So if you're an independent contractor for somebody, they'll give you a 1099. If you earn bank interest or stock dividends, you get a 1099 because that's non-employment income. If you earn commissions or royalties, you get the 1099. So basically any income that you weren't technically an employee, so they didn't take taxes out, that comes on your 1099. And that also gets reported, both of these also get reported to the IRS. So some people in the past have, pretended they didn't get the 1099, like, no, it never happened. I never earned that money. But they know you did. So the W-2 has more information on it than the 1099. The W-2 will have your wages, and they split it into taxable and Social Security and Medicare wages. It has 3 blocks, and we'll explain the difference between that in a little bit. It will have any taxes that were taken out. So it'll have your FICA taxes, Social Security, Medicare, anything that was taken out pre-tax deduction, like retirement accounts are allowed to be taken out of your paycheck before they calculate taxes. Flexible spending accounts for healthcare take out of your check before they calculate taxes. All that has to be reported on your W-2 because that's part of what's going on with your taxes. So that will all show up on your W-2. With the 1099, there's very little information. Usually only 1, maybe 2 boxes are filled out, like your name and address and then your income, and that's it, usually. Sometimes there'll be a little bit more on there, but very, very rarely. Any questions on those? Okay, Barbara started a new job and she wanted to verify that her pay was correct. Her gross pay was $269.75. She had a 6.2% FICA, that's Social Security. 1.45% Medicare. Federal withholding tax of $47.51, state withholding tax of $16.62, retirement, disability, medical insurance, and dental insurance. So we want to know what should her pay be. First thing we need to figure out is to make sure Social Security and Medicare are correct. We know those percentages. Those are set percentages. It's really hard to double check to make sure your tax taken out was correct. That kind of gets reconciled at the end of the year. You can't really do a lot about that during the actual pay periods, but you can always check your Social Security and your Medicare because you know the percentages. The percentages will always be 6.2 for Social Security and 1.45 for Medicare. I shouldn't say always because they do change them periodically, but they haven't changed them in like 6 to 10 years. So, they don't change very frequently. Okay, so Social Security, we take that .062, which is 6.2% converted to a decimal, and we multiply it by her pay. and we get that 1672 should have been taken out. And then Medicare is 0.0145 times her pay. And she should have had 391 taken out. Okay, so now we know how much those amounts are. We take her pay and we subtract the Social Security. We subtract the Medicare. We subtract her federal tax. We subtract her state tax. We subtract retirement. We subtract disability and medical and dental. And that will give us the net pay. Okay, so her paycheck should be $155.43. You should do this. When you get a paycheck stub, you guys should do this. You should check your paychecks. Yes. It happens. I've had it happen to me. I know other people that it have happened to, that instead of typing in like $9, maybe they put 90. You know, I mean, it can be that drastic. Or instead of doing like 47.51, maybe they did 74. You know, they transpose the numbers. It happens. What happens for most companies, send their payroll off to payroll companies, like other companies that specialize in doing this and cutting the checks, and then they deliver them and they get distributed. But they're taking in all this information, timesheets or computerized time cards, and then they're processing it. But every individual might have different insurance, might have, there's a lot of things, and so mistakes happen. This is a pay stub, and they will do this. They have the current, this is this week, and this is the year to date. So we're at March 28th, so from January to March 28th, these are the amounts that have happened. Okay, assuming that her salary and deductions remain the same throughout the year, how much will be taken out of her total annual gross salary for federal and state taxes? Okay, she's getting paid from the 15th to the 28th as a 2-week pay period. Okay, so this is a 2-week pay period, bi-weekly. It's right here. Okay. Okay, so 2 weeks. How many paychecks is she going to get in a year? Yeah, 52 weeks in a year, right? Yeah, we're going to divide that by every 2 weeks, so she's going to get 26 paychecks. So 26 times this amount is going to come out, federal and state taxes. So you can either multiply each of those by 26 and add them together, or you can add them together and multiply by 26. Either way, I like to add first. Bless you. It helps if you push the right button. I'm using the calculator so I won't do the math wrong and then do the calculator wrong. Okay, so 1282.36 each times 26 checks. So she's going to have $33,341.36 deducted from her paycheck in taxes, which seems like a lot of money. But if you think that she's getting $4,600 every 2 weeks, We could calculate her gross salary if we wanted to. Okay, so she's making $120,000 a year almost. So that $33,000 in taxes doesn't seem like as much. Here's a W-2 form. This one here was the 2012 version, but they pretty much look like this. And W-2 forms are fairly universal because most people get the template off of the IRS website. So if you go get a W-2 form from any company, it will pretty much look just like this. Okay, this section up here is where your Social Security number is. This is really important to make sure that's correct, because if it's the wrong Social Security number, that can cause all kinds of problems because all of the income taxes are based off of Social Security numbers. This is the employer identification number. So this is their tax code, their address, your address. Not if there's an old address on here, like you moved halfway through the year or something, not that important, but you'd want to correct it for like the next year. Okay, here we have wages, tips, and other compensation. So this is your gross pay. Okay. Should say taxable, sorry. Taxable gross pay. Social Security and Medicare wages, there's normally going to be a number here too. Yeah. This is your actual gross pay. Okay, and then normally there's a number here too. I don't know why there's not in this example, but here is the federal tax withheld. Then this is Social Security tax withheld. And this will be the Medicare that's been taken out. Now these two, Social Security and Medicare, you don't get those back. You get Social Security and Medicare back like after you retire kind of thing, but this is not part of your taxes. Okay. Now, these other boxes, Social Security tips and allocated tips, honestly, I've never seen anything there. Advanced EIC payment, that's earned income credit payment. You have dependent care benefits, non-qualified plans, and then you have these other boxes like this one where it says other, and I cannot read those right now. So this one is retirement plan. There are different things that you can have money pulled out from. If you have a flexible spending account, if you have a retirement account, that's the kind of things that go here. If union dues were taken out of your check, that might go here. If you have a dependent care account, that would go up here. Just different things that came out of your check that affects your tax bill have to be reported, and they'll be reported in this area. And then you'll have codes. So a retirement account might have one kind of code. A flexible spending account will have another kind of code. And the code will go here and the amount will go there. Down at the bottom you have your state and local taxes. And as I said, here we don't have those. Now if you do live in a state, for example Georgia has state income tax. if you were to go to Georgia, you're going to have to file your federal income taxes, and then you also file state income taxes. You have to do 2 different filing. California also has a state income tax, yes. Like I said, most states do. All right, so 10 states, no income tax. All right, so how much did Joanna pay in taxes? Well, Joanna lives in a state that has a state income tax, and it just says taxes. So she has federal taxes, she had state income tax, and she had local income tax. So she had 3 taxes. When we're talking about taxes, we're not going to talk about Social Security tax. Even though it's called a tax, it's not really a tax. It's more like a savings account for when you retire or become disabled. Right. You get it back later when you retire. And then the Medicare that gets pulled out of your check goes to pay for the medical insurance when you retire. So Social Security and Medicare are retirement benefits, or if you become disabled, you can collect them. So it's not like a tax per se, it's more like a here's for later. Yes. It's an insurance program more than anything though, because you don't exactly get back the exact dollar amount that you put in. You could get more, you could get a little less, but it balances out. But we have 3 taxes: the federal tax, the state tax, and the local tax. Now, state income tax is deductible from federal income tax if you itemize your deductions. So sometimes it may be beneficial to do that, and sometimes it may not be. And we're going to talk about itemization later, but just know that this income tax down here is deductible. And so Joanna paid $22,287.50 total for her taxes for state, federal, and local. Amy works for Pound Ridge Financial Planners, and he uses this electronic W-2. What accounts for the difference between her wages and her Social Security and Medicare wages? Okay, so this is what I was talking about, how sometimes you can have different numbers here. And if we look at this, we have a $78,000 and we have $92,100. Okay, so there's a difference between those 2 amounts. So her Social Security wages and Medicare were $92,100, but her wages and tips were $78,900. Okay, so the difference is $13,200. Social Security and Medicare are calculated without deductions. Okay? Social Security and Medicare are calculated on your total income. Whereas your box 1 here, wages, taxes, tips, and this is after deductions. Okay, so what happens is there are tax-exempt deductions. Things that can come out of your paycheck, that come out of your check before they calculate your income tax. These are things like a retirement plan, we've talked about that, a flexible spending account, some child care, and then some other types of insurances and things like that. Okay. That will account for the difference between box 1, which is taxable wages, and boxes here, which some other insurances, etc. And then this one is total wages. Okay, so box 1 is your taxable wages. Social Security and Medicare wages are your total wages. And if you look at, the question was what accounts for the difference? Right here. We have a retirement plan and a health care plan, a flexible spending. This is $13,200 difference. These came out pre-tax. Yeah, is it not on there? Okay, go to the next page and see if this is on there. Maybe they got mixed up. Okay, well, does this make sense though, even though you guys don't have it to write it down? It'll be online. I'll put it online so you can just go print this one page, like one piece of it, and add it to your notes. Or I can bring it tomorrow. Sorry. So you guys have this one, right? Okay. That's so weird. Okay, tax-deferred contributions. Retirement accounts are tax-deferred contributions. Your money can be placed into a special type of account, and there are different kinds of retirement accounts. There's IRAs, there are 401ks, there's a lot, okay? The money gets placed, that word's qualified, into the account tax-free. Now what happens is you do pay taxes on this income, you just don't pay it until you pull it out of the account after you retire. So the idea is, because you're putting, let's say, $200 a month into an account for retirement, you're earning interest on that $200. The idea is that the interest you earn on it is going to be worth more than the taxes they take out later. So you do get taxed when you pull the money out of the account. It counts as your income at that point in time. The cafeteria plan, that's a little different. The money comes out of your paycheck pre-tax, and it can be spent on certain things. Medical expenses, certain medical expenses, nothing cosmetic. It has to be like genuine medical. Child care, parent care, so if you have an elderly parent that's in a home, and some non-reimbursed medical insurance. The flexible spending account is a special kind of cafeteria plan. It's employee sponsored. With a flexible spending account, that non-reimbursed medical insurance part up there, you can't use your flex account for medical insurance. They don't allow that. But the other things, the medical, the child care, dental, things like that can be used with this flex account. With the flex account, if you don't use your money by the deadline, you lose it. The deadline is December 31st. Some accounts allow a grace period, usually till March, if they do allow it, like till March 1st or so. But not every account offers a grace period, so it just depends. Okay, and then we have the 1099 form. I'll go over it really quickly. As you can see, a lot less information. See all these boxes? They can be used for stuff. Most of the time, only one will be filled out. They're different types of where the income came from. So you have royalties, other income, fishing boat proceeds, like just, you'll have one. And then this is the federal income tax withheld, and this is almost never. Now, I won't say never, but it's almost never. So the 1099 is for non employee income. Okay. Everybody